Our next speaker is Sebastian Evans. Sebastian is the MD and CIO at NAOS. They have two well-known LICs, namely the NAOS Emerging Opportunities LIC and the NAOS Absolute Opportunities LIC. Please welcome Sebastian to the stage.
Great. Thank you very much, Peter. And to be honest, my presentation is probably going to be a little bit different to everyone's. I'm not going to talk about the economy. I'm not going to give you any stocks, and I'm not going to show you our performance tables. So hopefully you'll be able to stick around for the next 15 minutes. I think what I'm here to do today is to try and help you find, in my view, what to look for in a fund manager. I think, especially over the last 3 to 5 years, fund managers have probably been under more scrutiny than ever, and that probably is not going to go away anytime soon. It is impossible to produce a superior return without doing something different to the majority. It's on the first thing you see when you walk into our office, and I sort of live and die by that quote every day, I suppose, and that's the way our portfolios are made up. The way funds management industry has changed is with the rise of ETFs, fund managers are under more and more pressure, not only to produce returns, and if they can't produce the returns, they'll be lowering their fees, but to provide a difference. And I think that's the most important thing that I'm trying to get across today. Everyone has, I suppose, a stock checklist. I mean, I can talk about quality, I can talk about value, I can talk about cash flow, and they're all feel-good words. But at the end of the day, they're quite, in my view, I think they're quite, very broad strokes. When you look at a fund manager, people will look at track record, income, the management team, I suppose how long a fund has been around for, and the consistency of their strategy. I think when we look at a fund manager and our own product specifically, the first thing we look for is, are we adding value? Can I go to you and I suppose be passionate about the strategy that we're trying to get across and effectively trying to sell to you? Where does it fit in your portfolio? And I think at the end of the day, if you can do it to the extent we can, maybe give or take 1%, then the fact is you probably shouldn't be using a NAOS product. A big thing for me is, and I think if you look at our funds especially, we're the largest investors in our funds. I don't own any stocks outside of the NAOS products. If it's good enough for the NAOS funds, if it's good enough for me, then it's good enough for the NAOS funds. And that's definitely not an industry-wide phenomenon. Fund size is a big one, which I'll touch on. It's easy to turn maybe $100 into $1,000 over time. But when you're running $500 million, $1 billion, $30 billion, $50 billion in some cases, it's not as easy, and it's almost impossible to beat certain indexes, no matter how large those indexes are. And finally, on the subject of fees and benchmarks, I know it's been brought up a lot today, but you can see that, in my view, the industry is very much moving towards absolute benchmarks. Yes, people want income, but as I'll show you, income can only happen through profits. And I think at the end of the day, if a fund manager is not producing returns, especially returns in excess of the benchmark, then there's no way they're going to be able to pay out a sustainable income yield. So it's very important for us, and especially for our products, yes, to pay income, and we talk about it a lot, but it has to be sustainable, and it has to grow, and we have to have enough for a rainy day. So I suppose a bit of an investing idol of mine, Howard Marks, does very well, I suppose, in the unlisted debt space, and I suppose very much a value investor. Talking about ETFs. The rise of ETFs. Now, quick stat. So the Vanguard funds in America, for example, now represent 8% of the S&P 500. You could probably work out where that 8%'s come from, and it's probably come from a lot of managers that have probably made their life a little difficult, who call themselves active fund managers, but unfortunately they're giving you passive returns. And at the end of the day, people have gone, well, I've had enough of that, and instead of paying my 1% and maybe a small management fee, I'm going to give it to Vanguard, who I'll pay 0.1% or even less in some cases, and get index-like returns. I think fund managers have made it very hard for themselves because, a lot of us will get up here and say, yes, we're active, we provide active returns and active portfolio management. But at the end of the day, when you look at long-term returns, if I'm only beating the index by 0.5% or whatever it may be, I think the fact remains I'm probably more of a passive manager. And it comes back to why do fund managers follow benchmarks? Why are they tied to things like CBA, Telstra, Wesfarmers, CSL, or whatever it may be, just because they're the largest companies in a given index? An interesting chart is a $2 trillion differential between the flows into active funds and then out of active funds and into passive funds. And this will send shivers down every fund manager's spine, I would have thought, including mine. And the fact remains that over the last, give or take, I think this is maybe over give or take 7 or 8 years, that fund managers, active fund managers, have been losing flows at a rate of knots. And it's going straight into the passive strategies because people like yourselves have been given the access to ETPs, to ETFs, even to I suppose, low management fee passive strategy LICs that can do it for you at a low cost. And the other thing that I've mentioned before is that active managers simply haven't been able to perform in many circumstances. And a lot of that comes down to volatility. We've probably gone through a period of time where volatility is at record lows, and there's been a lot of talk that that's looking to change. But when volatility is very low, it's hard for fund managers who run many stocks to produce returns because the dispersion between stocks, the amount of stocks that go up and down, and I suppose at what sort of volatility, has been minimal over time. And that's made it hard for them to produce returns that have been in excess of the benchmark to any reasonable degree. Behind a company, you should find out what it is actually doing. And I think it's a very simple quote. We run a very simple portfolio. In our small companies fund, for example, we own 11 stocks. They're very simple businesses. They're not hard to understand. I'm a big believer if you can write it down on a piece of paper, they're the type of businesses you should be investing in. I think if you look in some of the larger stocks in the index, for example, you look at a Wesfarmers, you look at maybe even a Telstra, some of the larger banks, a Woolworths, or whatever it may be, over time they've been forced to diversify. They're forced to diversify because their respective markets in Australia become too small, they become too large a player, and then they go into adjacent industries where they're no longer the expert, they're no longer the dominant player. And I think Telstra's been a great example recently on that, Telstra trying to become the technological bleeding edge, I suppose. And I think they've done nothing but lose many billions of dollars in a number of investments. But they're forced to do so. And the pressure that puts on people like me, for example, if I was investing in Telstra, is you have to get a better understanding of that business. And ultimately, in my view, it dilutes your information advantage, and your knowledge of that business becomes diluted. So your investor take, I suppose, higher risk bets, in my view, because these businesses are not the simple business models that they were. And probably, in my view, they're not the simple business models that made them great in the first place. I think if you look at the businesses, for example, I went through it this morning. So Ramsay Healthcare, TPG and REA, all very simple businesses. Over the last 10 years, they've compounded 30% returns per annum. If you look at BHP, Woolworths, I've actually forgotten the other one. It was BHP, Woolworths and another one. I think the compounded return over 10 years was 2%. I would argue they're more complex businesses, and I'm not saying I'm not here to generate 30% returns year in, year out, but I'm saying they are simple businesses that over time have developed into very large businesses. The Australian story, so I'm just going to refer to my time so Peter doesn't get up here and kick me off. Everyone knows about it. I'm sure if I got everyone here to put their hand up on what they own, I'm sure all these stocks would be in the portfolio, as I've learned over the last few years. And what's interesting is, and this is why people will invest more and more offshore, is they all have some form of headwind in some way or another. So obviously the big four banks, it's all been about financial disintermediation, so the peer-to-peer lending. Non-bank lenders are rising, albeit off a very small base. Banks, they're pulling out of things like obviously super, NAB looking to sell MLC, for example. They're looking to go back to their roots, but unfortunately their roots are going to come under more and more pressure, in my view, over the next 5, 10, 15 years. Telstra, I'm not going to talk about it because it's been spoken about so much today. Wesfarmers, everyone talks about, we invest in a building supplies business, albeit it's a lot smaller than Wesfarmers. In the States, for example, if you want a hammer or you need building supplies, you order it through Amazon, it's on your doorstep in 4 hours. The days of Bunnings, in my view, although I'm not an expert, I'm sure that would put them under a significant amount of pressure in the future. And then finally, BHP. Obviously, it's gone through many iterations. Obviously, there's South 32, they've done spin-offs, they've split the business. But ultimately, again, like the activist investor, I forgot his name, but, they diversified obviously into oil, they've got the coal assets. But over time, there'll be, in my view, there'll be more and more pressure as you can see more and more investors looking for renewable energies, looking for sustainable investment strategies and sustainable business models. And over time, that may very well put BHP under pressure in regards to its own earning streams. So the Australian story, and I think in regards to fund managers, it is a fact that small to medium cap fund managers outperform their relative indexes. Now, for all the cynics in the audience, everyone will come back at me and say, well, there's a lot more resources in those indexes, so it's easier for fund managers to outperform. True. But I would say if you look at the top 200 fund managers, a big reason why they don't outperform is because they simply own too many stocks. I mean, if someone in the crowd out here today said, give me 30 stocks that you own, as I said, I don't own 30 stocks because I couldn't find 30 stocks that I want to invest in. So if I ran 70 stocks, to be honest, I don't know how people run 70 stocks because I couldn't put hand on heart saying, you know what, I'm going to make my investors money over the longer term. It just wouldn't happen. We're flat out finding 12 stocks. And the reason why people can't beat the benchmark in the large cap indexes is because they index hug to those larger stocks. You know, fund managers are inherently conservative. Everyone talks about risk. No one talks about return. So for a fund manager, they're going to own the banks to a certain extent, or Wesfarmers or Telstra, because they're too scared, in my view, that those stocks are going to run and they're going to be left behind, regardless of whether or not they think they're a good investment. Good quote. This is actually going to be in our investor roadshow. We're going to give everyone a little 20 hole punch card so you can pick 20 stocks. And, you know, if I told people, if you looked at our small companies fund and you looked at it 3 years ago and you looked at it today, about 70% of the stocks are the same 70% as what they were 3 years ago. So some people say, well, why do you have a job if you're not investing that much? But in my view, and I've learnt the hard way over the last 10 years, you know, some of the best decisions you've made are the decisions that you never make, the ones that you continue to hold. I think it's a big misconception out there. You people all the time. I've worked for a number of very successful people, and they say, "Sell your winners. I want to keep my losers and get my money back." Doesn't happen. Never happens. Always, it's a guaranteed recipe for failure, in my view. But, you know, the big effect and what people miss out on is the compounding effect. To continue to compound off a higher base, if you do 10% in the first year and then 12% in the next year, you continue to compound off a higher base. I'm sure this is very simple for all of you, but it's extremely powerful, and a lot of people forget that. So if you continue to hang on to your winners, if you think they represent excellent investments, it's very hard to find another investment that has an excellent management team, a good balance sheet, you know, industry thematics that are going in their favour. You don't find them every week, regardless of whether or not there's 100 stocks in your universe or 500 or 2,000. They are hard to find, so we're big believers that you stick to them and stick with them for as long as they represent fundamental value. Just quickly, in diversification, I actually don't think I'm going to get my presentation finished, so I might just stop halfway. Big believer is people, as I said, people talk about risk and return. It's a big believer that, in our view, that people over-diversify and it dilutes their returns, and that chart does show you that. That quote, to be honest, I'll move on and get straight to the point. But fund managers are a big, I suppose, victim of their own success. The larger you get, the harder it is to perform. And this looks at a fund manager's returns on size versus relative to performance. And it shows you that as they've gotten larger, the performance has fallen through the floor. I'd much prefer to be incentivised on performance fees than just raising large amounts of money on management fees. Interesting one. So I suppose what incentivised me, and there was a Charlie Munger quote, and I'll finish here, Peter, sorry. It looks at, show me the incentive and I'll show you the return. You know, when I come into work, my number one goal is not to find 10 new investors. That doesn't incentivise me. My number one goal is to produce excellent returns for my investors, regardless of the size of the fund, because fundamentally, I will do much better through performance fees than just through the management fees on a larger fund. If I run a larger fund without performance fees, I don't see the incentive of performance. I don't get it. But if I run a smaller fund with a higher performance fee, with an absolute benchmark, say 8% or 9%, that doesn't reset, so I have to continually produce positive performance, that aligns me with you, and I'm incentivised to come into work every day to pick stocks regardless of the size of my fund. I think more and more fund managers will go to this, and I will get many investors to have a look at what you're investing in. Does the performance fee reset? Is it applicable on negative performance? Do they even have a performance fee? Because I think a lot of people are very negative on performance fees, but in my view, they very much align you with the fund manager, especially if their own money's in the fund as well. And finally, on investment structure, I'll leave it here, but I would say LICs are very powerful tools because people have mentioned they're closed vehicles, they're long-term vehicles, and in my view, especially with managed funds, when you look at how income is paid, be very careful. A fund has to perform to pay income, otherwise you're getting capital paid out. And I stress people should look at the differences between that because many LICs out there do pay dividend yields, but I would stress go and look at the profit reserve account and go and look at the franking reserve account, and that'll give you a very good idea of how sustainable that dividend is when markets do finally take a breath. So thank you very much for your time.